Hello and welcome to another episode of the Mark Moss Show, where we talk about the decentralized revolution that is changing the world as we know it today. Of course, we talk about it as Bitcoin, cryptocurrencies, technology is changing the world as we see it. And so I'd like to bring you some education to kind of help you see this. It's hard to see a new system when you're stuck in an existing system. A lot of times we get, miss the forest for the trees sort of a thing, where we're so inside of one system, or we're so zoomed in that it's hard to see the perspective of what's going on. And so I'd like to bring you some education to help you think about that. Of course, I'd like to bring you the latest breaking news and information so you can stay up to date each and every week. And then, of course, we talk about, or I'd like to bring on some new guests so you can hear some different perspectives, so you can get a well-rounded view of things in better context of what's happening today. And boy, each and every week I love joining you because there is so much to talk about. It's a good problem to have. A consultant I used to work with said these are high-class problems. And so I've had problems in the past where there was not enough information to talk about. I remember doing content through 2018 and 2019. Things were really boring back then. Now the problem is too much to talk about and trying to choose which stories to talk about. And so, like I said, it's a high-class problem, and that's all good. But, I want to kind of put things into perspective of what's going on. And a lot of what we've been talking about over the last month or two is really a kind of a continuation of what's going on. And I'm kind of giving you the play-by-play of how things are unwinding. And so I've been talking about something called the Crypto Unwind, or I was calling it the Great Unwind. And what I'm talking about is an unwind of leverage, or deleveraging, if you will. Now, we see that there's leverage all over the system, and typically leverage is built up through credit. Now, in our existing monetary system that we have in the world today, it's a debt-based monetary system. And so that means that all money that's created is debt. So we talk about the Federal Reserve just printing buttons, pushing a button and printing money. That's not really the way it works. Money is created through debt issuance. So when you go get a loan for a car, boat, house, boat, whatever, that money is created into existence. And it creates massive amounts of leverage because it's all debt. So think about it for your own self, like your own personal household. Let's say that you were using leverage to build assets. Let's say you were back to 2008, as a matter of fact, is a good parallel to what we're going to talk about today. So back in 2008, people were able to buy multiple houses at the same time. And so people would go to these like new housing developments in California or Arizona or Nevada, Florida. Those are kind of the hot spots of the country. And these home prices were exploding so fast. They were going up so fast that people could just go to a brand new housing development, put their name down, a deposit down on a house, sometimes $1,000, $5,000 down on a house. And then once those houses were built, they could just sell them and make $20,000, $30,000 per house times 5 or 10, however many they bought. So they're putting $1,000 or $5,000 down, and then they're making $20,000, $30,000, $40,000 down on a house. They're using leverage. It was that credit that was being extended to them. And that works great. You can grow really, really fast with that leverage. Another way you can use leverage is, let's say that your business is expanding. Let's say that you were in the construction business, and so obviously construction business was booming, and so we needed contractors to go out there and frame the walls and hang the drywall, put the roofs on, build the fences, do the landscaping, etc. And so I might have, or other people might have gone and bought 5 or 10 homes at a time. A lot of people were doing this, and so there's a lot of demand for houses. And so now these contractors that deliver these services also use leverage, and so they would go out and take loans to then buy more trucks and buy more equipment and hire more crews. And that leverage, that credit that was extended to them, allowed them to build much faster, to scale their business, to take advantage of all that incoming business. And so leverage works really well. Debt, leverage, credit, whatever you want to call it. That credit, that debt, that leverage allows us to grow really fast. And if you were playing this real estate game, you were leveraging that credit and you were getting 5, 10, 20 homes, and they were growing really fast. Or you're building your business really, really fast. That was great. The problem is when we get to the end of that credit cycle. So throughout this long-term credit cycle, we're using more debt, credit, leverage everywhere, growing. Not just you, not just the roofer, the framer, the window guy, the landscaper, etc., but the homeowners buying the homes, but the whole system. The entire monetary system is basically doing that. So we have these long-term credit cycles, and all this credit debt leverage builds up in the system, and we grow. A massive growth. Gross domestic product is exploding. The economy is doing good. There's more money. People are going and spending more on clothes and at restaurants, and then those restaurants are expanding, etc. So you can see how this winds up. The problem is when it unwinds down. And so just as fast as it grows on the upside, it actually unwinds and deleverages way faster. Now you can think about this easy. It takes a while to take on debt, to continue to build your portfolio using debt, but you can just default on that debt instantly and all that can just disappear. And that's exactly what happens when things turn. And so back to 2008, all those people that had used debt, credit, leverage to build up those portfolio of all those homes, all those contractors who had scaled their businesses and bought all new equipment and new trucks, etc. And then as soon as the market started to crash, it just started to unwind really, really fast. And of course, it led to the great financial crash, 2008. The entire banking system had built up so much leverage because then people were buying homes, and then those homes, those loans were being sold off, and then companies were buying giant packages of these home loans, and they were bundling them together, packaging them together, selling them off in tranches. And then Wall Street was taking these packages, they were repackaging, bundling them, and they would take some high-risk ones, some low-risk ones. They'd put them all together to try to get this blended risk model, and they'd package them together, and they'd sell them off, these mortgage-backed securities, they were called. And so leverage built up from the individual homeowner through the contractors, but it built up all the way through the financial system, all the way through Wall Street and into the global financial system, where all the banks of the world were now trading these mortgage-backed securities. And it became a big mess. So when the financial system crashed, there was exposure to all of this, and this great unwind just dragged everything down. Now, I've told you that story just so you can get an understanding of something that you understand, something that you know, so you can understand how this crypto market crash is also part of the Great Unwind, and how it's interesting that we saw Bitcoin was created out of the great financial crash. As a matter of fact, it was who was developed by Satoshi Nakamoto, famously put a line of text in the very first block that was mined on the Bitcoin network, saying that the chancellor is on the brink of another bailout. So basically showing that this was because of the bailouts that was happening with the banking system. And so he wanted to create something in response to that so that we could get rid of those problems. We wouldn't be subject to those problems happening again. A lot of times it's hard to see where decisions or where things will take us. And so mistakes are made, right? A lot of times people think that we should, move fast and take chances and break things. But you're trying to learn from those mistakes so you don't make those same mistakes again. My dad told me over and over and over as I was growing up, he pounded into my head, always that once is an accident and twice is stupid. And so that means that, hey, look, we all make accidents, right? Let's just keep trying, we'll make accidents. But just don't make the same mistakes again. But unfortunately, we make the same mistakes again. Unfortunately, two things. I think one, they say that history doesn't repeat, it rhymes. Well, it does repeat, and it does rhyme. So we see that happening again. And so they say those who don't know history are bound to repeat it. But then also we have human emotions like greed that get the best of us. And this time will be different, and we're going to go ahead and bet it all. And so I like to say that this leverage is like fire. It can be used to warm up your house or cook your food. Those are good things. Or it could burn your house down. So I want to explain to you how the Great Unwind in the crypto market is very similar to the 2008 financial crash, what we can learn from this, more importantly, what we can see, how we come out of this, how we can navigate it. I was talking about how Bitcoin, which is the technology leading this decentralized revolution, was designed after the 2008 great financial crash to prevent a lot of the problems that we saw from that crash, but unfortunately, we sort of ended back in the same place. And what I'm calling the Great Unwind. And I'm talking about an unwind of all this leverage, all this credit, all this debt that's been built up in the system. And so I want to kind of break that down so you can see what happened, but also how we can navigate this correctly and how we can maybe learn from these mistakes so we don't get caught up in this again. Now, some people were caught really, really bad. And I've heard, unfortunately, countless stories of people who have lost everything. And some people were caught up a little bit, maybe their paper gains went down on paper. Now, if your paper gains went down a little bit, whatever. Those paper gains were just paper, and they'll come back eventually. But some people lost real money. As a matter of fact, I was in Austin at Consensus. It's the largest cryptocurrency conference. It was about a month ago. And I was at an after event, and some guy came up to me and he said, "Hey, Mark, I'm a big fan of your show. I've been watching your stuff." And that was cool. We talked for a little bit. And he said, I've been in marketing my whole career, and I built up this company. We specifically did marketing for Medicare and government-sponsored healthcare stuff. And it was a great business, did really well for me, and I made a lot of money, and I just sold the company. We had a big exit, and I'm ready to move on to the next stage of my life. He's over 50 years old. I'm not exactly sure how old he was, but over 50. And he said, "I'm ready to move on to this next stage of my life." And I came to this event, I booked this event, and I bought the whale pass. I bought the most expensive pass I could get so I can come network and try to find my next opportunity. He said, "But I had taken all that money from the sale of my business, and I had put it into this Terra Luna stablecoin because it's supposed to be stable. And it offers me this awesome 20% yield. And unfortunately, I lost it all. All his money. He'd built this business for most of his professional career, had a nice exit, was looking forward to taking that money and moving on to the next stage of his life. He put it all in, and he got caught in the Great Unwind and lost it all. Now, he's not alone. There's probably millions of people that got caught up in the same situation. It's devastating. So I want to make sure that you don't get caught up in that same situation. And like I said, even if you're on the peripheral. So let's take a look at this. So as I said before, right, Bitcoin was created about 13 years ago, coming out of the 2008 great financial crash, trying to prevent it. And so one of the big problems, as I already explained, is that the banks had built up all this leverage, and then the banks basically caused this crash. Now, a lot of times people want to tell you that it was the homeowners were way too greedy, they bought too many houses, and they were the reason why the markets crashed. That's not true. Yes, homeowners did get too greedy, sure. But they were being given loans by Wall Street because Wall Street was too greedy. And Wall Street packaged these things up into these zombie sausages and sold them and got way too over leveraged. That's what caused the crash. And of course, all markets are cyclical and go up and down. So first of all, let me just say that the Federal Reserve, who backstops the banks, is supposedly, they're telling you and I, that they print all this money per this, what's known as Keynesian economics, in order to prevent booms and busts. Because nobody wants to go through a bust. Nobody wants to lose money, right? And so if they could just pump in more credit, more debt, when those bust cycles come, they could smooth that out. That's the story they tell us. Now, if you believe that, I might have a bridge that I want to sell you as well. Anybody with a few minutes online could look at charts and see that's just absolutely false. As a matter of fact, we have boom and bust cycles going back hundreds of years. And right when the Federal Reserve was created, 1913, the boom and bust cycles have gotten bigger and bigger and bigger and bigger every single time. And so they're not smoothing anything out. Now, boom and bust cycles are normal because we're humans and things change. Styles change. What we want and need change. Greed happens and people go too far one way and then they have to swing back the other way. There's all types of reasons why. I was a manufacturer selling what were those last things? Oh, those fidget spinners, for example, right? That was a huge boom. Everybody wanted them. You're ordering tons and tons and tons. You can't keep up with the demand. And then all of a sudden, nobody wants them anymore. And anybody who jumped into that business and was manufacturing those things and had ordered a bunch of inventory, they had a bust. It just happens, right? People got too over leveraged in that probably. And so that happens. And so unfortunately, that's just a natural process. Just like the world, we have seasons, right? Spring, summer, winter, fall. And so the spring, everything grows, and the winter, everything dies, and it keeps going, or like a forest fire. Anyway, back to 2008. So the banks created this problem. We had Bitcoin that was created, and Satoshi Nakamoto put a quote in 2009, and he said, quote, "Banks must be trusted to hold our money and transfer it electronically for us, But they lend it out in waves of credit bubbles with barely a fraction in reserve. And they don't even have any reserves today. So basically, they're sending out this money, creating credit bubbles. That's what he talked about. So we give our money to the banks, they loan the money out, and they create these credit bubbles that inevitably crash and cause a fall. There's a great movie that talks about this, 2008, The Big Short. If you haven't watched it or read the book is amazing, or you could watch the movie. It's got some great actors in it. And there's a quote that says, "They mistook leverage for genius." So this kind of goes back to Warren Buffett's quote that a rising tide raises all boats. And so when the markets are going up, everybody looks like a genius. You can just close your eyes, buy anything, and you can make money. And then you use leverage, and then you look really smart because you made more money than everybody else. So he says, the quote, "They mistook leverage for genius." And so that's exactly what happened. Now, over the last couple months, we've been seeing the effects of this in the cryptocurrency market. And we've been seeing basically all these cryptocurrency industry giants have been melting down. And they've been basically toppling each other like a set of dominoes. The smaller ones leading to the medium-sized ones, leading to the bigger ones. And now we're pretty much wiped out of that. We're still dealing with that, but most of the leverage has been wiped out. But it was basically like a bunch of nukes in the balance sheet of these crypto lenders that were supposed to be holding money, but they were really just turning themselves into over-leveraged, risky hedge funds. So I want to talk about how this unwinds, where we're at with this, and how we move forward with this in a minute. And so we've seen, like I said, these crypto lenders that were supposed to be like banks. They were supposed to receive your deposits and then be very careful with them. Instead, they turned into very risky, over-leveraged like hedge funds. And one blew up, and then it had exposure to the next, the next, the next. And we saw hundreds of billions of dollars worth of notional value just collapse, just gone. Hundreds of billions of dollars of value gone like that. And that's real money. I mean, it was on paper, but a lot of people were expecting to have that money, and now they don't have it. Now, I've been reporting over the last couple of weeks. I think it's pretty much done. As a matter of fact, the founder of FTX, CEO Sam Bankman-Fried, he's come in and backstopped the last couple of exchanges that look like they're at risk of blowing up. And he has said that he thinks it's over. I obviously am agreeing with him. Now, as I said, this is really happening because of the leverage and the debt that was built up. And it builds up really fast when markets are going up, as I've explained. When they wind up, it's the unwind that's the problem, just like in 2008. Now, Bitcoin was, like I said, supposed to help us with this because now, for the first time, we could custody our own money without having to give it to a bank. See, the problem, so Satoshi Nakamoto said, if I go back to the original quote, banks must be trusted to hold our money and transfer it, but they'd lend it out in waves of credit bubbles. And so rather than give them our money and trusting them, we could just hold our money on our own, and we don't have to give it to them. And we don't have to have them put it at risk. It's what's known as counterparty risk, getting somebody else involved. We don't have to have that at risk. The problem is it didn't fix it. We still ended up in the Great Unwind. Which is where we're at today. Now, why is that? Well, there's a couple of reasons why, I think, and we're going to take a look at those. One is that, as humans, we have something that we suffer from called recency bias. So whatever's been happening recent, we just assume that's the way it is. Or normalcy bias. Whatever's been going on is normal, and we'll get back to normal, right? And so people are just used to putting their money in the bank. And they used to be used to getting a little bit of yield or a little bit of return from the bank. Of course, for the last decade or so, we get basically nothing from the bank. And so we're giving them our money, and we used to be compensated, and now we get no compensation. So these crypto banks, if we'll call them that loosely, they're typically called CeFi or DeFi, which is decentralized finance or centralized finance. The BlockFis, the Celsiuses, the Nexos, those are centralized finance, and then the Compound, the Makers, the Aave, those are like DeFi, decentralized finance. But basically, I think that people are so used to, it's so normal to just put our money into the bank that even though Bitcoin is a revolution that makes it so we don't have to do that, people still want to. So there's that normal recency bias. But then there's also the greed. So then it's like, well, why should I hold my Bitcoin or my cryptocurrency and it just sits there doing nothing for me when I could give it to this platform and earn 5, 6, 7, 8%, or I could do this and I could yield farm it and I could make 10 or 20 or 50 or 60%? And that's a good question. It's a question you should be asking yourself. You might ask yourself why someone would pay me 20 or 50 or 60 or 80% when the banks pay me none. You might wonder if it's too good to be true. Sometimes it is. You might wonder that there's some risk involved, and maybe the lower amount of return that you would get on that Bitcoin or crypto in the bank, in a BlockFi, Celsius, et cetera, might be less risky than some of those higher risk. You might ask yourself that, and if you haven't asked yourself that, you certainly should. But that's exactly what happened. And we saw, just like in 2008, all these banks had intertwined obligations and exposure to each other that brought down Lehman Brothers and AIG, et cetera. We see now 13 years later, the same thing happened where people took their Bitcoin and cryptocurrencies, which they should custody on their own, but instead they put them into banks. The banks started doing all these risky loans, started getting this cross-contamination to each other, and then it all went south. Now, some of these troubled entities, like BlockFi, for example, was able to get a bailout. So back to the 2008 financial crash, some of them got bailouts, like AIG. Some of them didn't. And so BlockFi was able to get a bailout. Now, the one difference that I have that I think is a very important difference to understand is that in 2008, if some of you guys are old enough to remember this, in 2008, supposedly the banks were going to melt down and the ATMs were going to run dry, is what they told us. And so the government had to step in and issue emergency credit of $700 billion. At the time, that was an amazing amount of money. It was like, no, you can't do that. It's going to ruin everything. $700 billion. But what's important to understand is that came from the government, from the Fed. That came from your tax dollars, meaning you socialize those losses. So the banks had private gains. All that money they made, that was made privately. They got to keep it. But when they lost, they didn't suffer the losses. Those losses were socialized through your and I taxes. Now, what's a little bit different in this crypto space is that no government or Fed stepped in to save any of them. Some of them saved each other. So, for example, FTX jumped in and bailed out BlockFi, but it wasn't coming from the taxpayers. And this is a big thing. So Bitcoin did sort of fix this, because what happens is we live in a world today with no personal responsibility. So, I'm free to make whatever bad decisions I want, and someone's going to come bail me out. Or, of course, these banks, they can be as risky as they want, and they can get a bailout. And so what we should see is these banks, when they make risky loans and they lose their money, they should go out of business. When the airlines, instead of saving their money or reinvesting it, they just bought a bunch of stock buybacks. And then when the markets turned south in 2020, they didn't have any money. They should have gone bankrupt. Like, they should have had some sort of consequence. Otherwise, it creates what's known as moral hazard. And again, that was something that came out of that 2008 crash, at least for me. A moral hazard, which is basically they have no moral reason to be concerned, because they know that no matter how much danger they get themselves into, there's a bailout coming. And so we need to see consequence, and that's exactly what did happen with Bitcoin and cryptocurrency, where these most of these agencies, that the Three Arrows Capital, the Terra Luna, et cetera, they took way too much risk. The people got involved with them and took way too much risk, and they all lost it all. And I don't wish that on anybody, but it represented responsibility, and those people hopefully won't make that same mistake twice. Like touching your hand on a hot stove, you don't want to do that again. But the problem is the moral hazard. What we have in the traditional banking system is that these banks make bad decisions and they get bailed out, which means they don't learn any lesson. As a matter of fact, the lesson they learn is that they should take even more risk next time, because they could make even more money on that risk. And if they lose it, who cares? Because they're going to get bailed out. But that's not what happened. Celsius didn't get bailed out. Three Arrows Capital didn't get bailed out. Voyager Digital had to declare bankruptcy. And like I said, it's unfortunate they took a lot of depositor money with them. Now, it cascaded from Luna, and then it went all the way down into what I'm calling the three horsemen of the crypto apocalypse. So I want to explain to you what these the three horsemen of the crypto apocalypse are. We'll talk about how we're coming out of this, what you need to know to survive this. As I said, people are just used to putting their money in the banks, and so they just thought they should put their Bitcoin and cryptocurrency into these exchanges and into these yield farming things. And a lot of people didn't think about the amount of risk that they were taking. And while I hate to see people lose money, like I said, we're at the age, I tweeted this out a while ago, that we're about to see the age of personal responsibility snap back. Look, man, you're responsible for your health. Don't listen to some doctor on TV. He doesn't know you. He doesn't know your own personal situation. He doesn't know your own risk profile. And so don't listen to him. It's up to you to take that responsibility. Now, I know the media is trying to tell you don't do your own research, but do it. No one's coming to save you. No one's looking out for your best interest because nobody knows you personally. So some doctor on TV, Dr. Fauci, he doesn't know what you need. He doesn't know your risk profile. So look out for your own health. They're not looking out for your financial health. That's up to you. They don't know what foods you need to eat. It's up to you. So, while I feel bad for a lot of people that have made the wrong medical decisions and it's now affecting them the wrong way, while I feel bad for a lot of people that have made the wrong financial decisions and now it's unfortunately been disastrous for them, hopefully they'll learn their lesson, and hopefully even better, you and I can learn from their lessons without having to go through that. But Terra Luna went down. Then it started to unwind the 3 Arrows Capital we've talked about. That brought down $18 billion in assets right from there. We've yet to see how big or what type of legal consequences this will bring, but we're expecting it to be pretty severe for some of the people. At least we're starting to see that kind of shake out. But then this has led into the Grayscale Bitcoin Trust. We talked about that. And so the Grayscale Bitcoin Trust has this massive discount. And as that discount has been going down, it's put a lot more pressure onto these companies that were holding on. And so we've seen that. But, one thing is that, like I said, this was supposed to bank the unbanked. So think about that for a minute. So right now, today, per the UN, there's about half the adults in the world today have no access to banks for a number of reasons. Mostly they're not allowed. They don't have permission to join banks. So the U.S. financial system and its the SWIFT banking system around the world basically has requirements called KYC, Know Your Customer. And so you have to have all this information and get permission to join the financial system. Now, if you're a kid growing up in a sanctioned country, you're in Iran, for example, you don't get to join the financial system. You're not allowed. In many other nations, they just don't have the right documents. They just don't have them. You live out in the sub-Sahara Africa or something like that, or deep in the jungle of South or Central America. You just don't have the legal documents to get a bank account. So you don't have permission to join. You're unbanked. Or in some places, even like El Salvador, for example, it's just too expensive to create a bank account. And so they don't have bank accounts. Now, I've talked a lot about this. I believe that this iPhone thing that we have, these smartphone things that we have are like the great equalizer, because with a phone, you can learn anything and meet anyone and do anything. And we've seen many instances of kids, not even teenagers, barely teenagers, creating a YouTube channel or an Instagram account and making $100,000 or more. So pretty much anywhere in the world, if you have access to a smartphone, you can learn anything, meet anyone, do anyone. But if you don't have access to the financial system, then you can't. You need access to the financial system. So we have about half the adults in the world today are unbanked, don't have access to banking. And so Bitcoin is supposed to solve that. So in El Salvador, for example, anyone can download a Bitcoin wallet, no permission needed, download it, and they could instantly start receiving and sending digital payments. They're in the global financial system. It's the great equalizer. And we're supposed to be able to reach the unbanked, so all these adults that don't have access to the financial system can now join the financial system and those of us that are banked, we could unbank ourselves instead of trying or trusting the counterparty risk of one of these financial institutions that have proven time and time again that they can't be trusted. Instead of being banked with one of them, we could unbank ourselves and we could move on to a Bitcoin or cryptocurrency thing. And that's how it was supposed to be. We were supposed to be unbanked. But unfortunately, like I said, even though the greatest technological revolution we've seen to date, me being able to hold my own assets. Now, what do I mean by that claim, the greatest technological revolution? Well, the oldest problem that mankind has had since the beginning is, how do I hold my assets in a way that can't be stolen? So we've made villages, and we've made kingdoms and cities and countries, etc. But Bitcoin has solved that. We don't need to trust somebody else. We can hold it ourselves. But most people still aren't in that. They still want to give my money to somebody else to hold it for me. Please just hold it. Celsius, BlockFi. Even Alex Masinski from Celsius went around telling people, people don't want to hold their own cryptocurrency. It's too complicated. It's too hard. It's too much. It's too risky. Just give it to us. We'll hold it for you. Well, look what happened. So, if I hold it myself, back to this age of personal responsibility, if I hold it myself, I need to be personally responsible for it so it doesn't get stolen. But it's not that hard to do. Now, if I'm trying to hold my gold, how do I hold my gold in a way that it doesn't get stolen? In the old days, I might go bury it and make a treasure map for it. But then I have to secure the map. What happens if I don't secure the map properly? If I have a lot of gold, I might have to build a big vault and a safe. I might have to have security there guarding it. It'd be very expensive. So it'd be very difficult for me to secure my wealth in gold. I could leave it under my pillow or under my mattress, but then if I'm gone, someone could come steal it, right? Or we could put the gold into a bank, and the bank could give us an IOU that we can come get that gold whenever we want. But then in 1933, the U.S. government seized everybody's gold that was sitting in the bank. And so you have option one, I store it myself, but I have to take responsibility. I have to take the risk of that. Option two is I give it to somebody else, but now I have to deal with that risk. And that's what happened with crypto. Now, hopefully you're learning from this. So the learning lesson to have here is that those that use these risky ways to earn yield, these DeFi yield farming, it was called, unfortunately, a lot of them lost everything. Now, I don't want to risk 100% of my investment for a 5, 6, 10% yield. That doesn't work. I want to invest 10 to make 100. Now, what about those who weren't involved in this? So this has brought the price of Bitcoin from 40 or 50,000 down to 20,000. So even me, not involved in these risky things, I've seen my paper value of my Bitcoin or cryptocurrency drop. So I got affected even though I wasn't involved in this. My hope is that because there was no bailout, most of these people learned their lesson. What I hope is that we don't repeat this again. I believe the paper value is going to come back. Like, I'm going to hold my Bitcoin, I'm going to hold my cryptocurrency. It's going to come back in value. So I lost it on paper. I'll get it back on paper. But I hope that we'll see these things be used less and less and less in the future, because at least this is different than 2008. In 2008, there was no lesson learned. There was no accountability. But in the crypto crash, there was. I believe people will go to jail. I believe people who lost money won't do this again. And I believe that we'll learn our lesson this time, and the paper gains come back, and we're all better off. But what do you think? I'd love to hear your comment. You can shoot me a message on any of the social media platforms at @1markmoss. That's right, at @1markmoss. Check out my website at onemarkmoss.com for more resources. And that's what I got to talk about today. We repeated, or we rhymed, we didn't repeat. Thanks for listening. Until next time. Since you've stayed to the end, I know you like this video, which means you're probably gonna really like this video right here and this video right here.